can hear you loud and clear all the way from Chicago.
Yeah, believe it or not.
Sorry about the Bears.
Well, that's,
Well, and
I'm a
Bears in the
Cubs
market,
fan.
Bears on the
Well, I'm
football
a
field.
Cubs fan, so
Me
I've
too.
learned my glass has been half empty for a long time in Chicago. So
Yeah, I thought it was
yeah,
surreal when they won the World Series. I thought it was an episode by Rod Serling. So, Dana, I
right,
really want
right.
to see your setup and some of the things you may be looking at. So you see there's a green share box,
Yeah, gotcha.
and you could share your screen that way.
Uh, okay.
You just click the
It
share.
says you cannot start screen
Well,
share
now
while
you
the other
can.
participant. Okay,
You can now.
okay.
Zoom.
Is it
Are you
working?
long Zoom for the Zoom ride? That's
Zoom.
what we're
No,
using. Yeah.
I like it though.
Okay.
Share.
Yeah.
See. Share. Is that
Yeah.
working?
It's coming up. Yeah, we got you, Dana.
Okay.
So, Dana, it's been far too long. I can't even remember how many years ago it's
Yeah,
been
it's been a
since we
couple of
last,
years. Yeah.
had a conversation. So, bring me up to date what you've been doing, because I know that you had an association with those guys at See It Market, and then I went and looked at your site, and you're also contributing content to Yahoo Finance.
Yeah, that that partnership kind of has fallen by the wayside. Well, they more or less scrapped that the Yahoo Finance program that they started. It was called Contributors on Yahoo
Oh,
Finance.
okay.
So it is as far as I believe, I do still have a Tumblr blog, which all the posts on Tumblr did feed through Yahoo Finance, and as far as I know, that is still the case. And I do contribute to See It Market from time to time, but we've kind of shifted our, the social media campaign a little bit. About 2 years ago, a lot followers and some of my readers, a lot of readers wanted a little bit extra in terms of, we have all this original research we put out and charts that we put out. People are always interested in the charts, and um, they wanted some next level stuff. So we're at the point where, okay, we're sharing all this stuff online, not seeing the benefits necessarily from it. So either we're going to scrap it, or we're going to actually go to the next level and give people, the inside scoop. So research and charts that we were sharing, people wanted to know, okay,
Okay,
what's the
your bread
traction?
and butter. Your bread and butter is the registered investment advisor, and you also have. I see something where you have a program for IRAs.
Yeah. So we have the bread and butter is the RIA, the Registered Investment Advisory, where we
You have a
manage.
good year last year.
We had a good year. Yeah, we're on a nice roll, so that's good. What I was going to allude to, we did start 2 years ago. We started what added on to our social media campaign. We started more or less a premium trading site. So we do share all of the charts and research that we're sharing, but we took it to a next level. So now we're for this premium, it's called Lion Share. You can go see it at lionsharepro.com. So what we do is same thing we were doing, sharing original research and charts, but we took it to the next level. So now on a daily basis, we have pre-market videos where we show all the
entries.
all the research, the behind the scenes research, all the charts we're looking at, actual things we're looking to buy and sell, and the specific levels and that type.
Well, I don't know. I was disappointed when the Wizard of Oz came from without outside the curtain.
Yeah,
He
well,
was much more mysterious while he was behind the curtain. But
yeah,
I
there
wish
is
you.
something to that. But
Yeah. So
at least there's transparency to the Wizard.
Yeah. And there's a lot of good work out there, Dana. And I remember You being an excellent technician, so why don't we get to it?
Sure.
What's that, the value line?
This is the value line geometric composite. Yep.
Okay.
So
So the message to me looks like an ascending triangle, like we're on the verge of a major breakout,
we could
maybe
see
after a pullback here or what?
we could see very well see higher prices. Our bread and butter is a quantitative risk model that we started back in the 1970s during that whole secular bear market, and uh, where we learned quickly that okay, stocks, the markets don't just go up; they go up and down. So we want to be on the right side of the market, and we use a lot of breadth and internal inputs to figure out where the bulk of the market is heading, and that's the right side. That's the side of the market we want to be on. And right now, our risk model is still constructive. Pretty much all the breadth and internal measures that we follow are still pointed upward, still constructive. So where one of the main drivers for much of this rally has been the large caps. So we've had here's the S&P 500,
Right.
obviously been moving higher for a long time, broke out to new highs several months ago.
Did you get any message from the VIX that we've made one heck of a run? I mean, all the way back to last year, the worst December ever. And yeah. VIX, for some reason, seems like there might be a new regime. It's not trading in the tens anymore.
The VIX, we were seeing a major divergence back in before I would say before this real breadth breakout, and call it October. So we kept seeing higher lows here in the VIX. Around here, October, November, when we saw that breadth thrust, we saw an acceleration of basically the broader market. The small caps broke out, mid caps broke out. VIX, we saw finally a lower low. So I think that's constructive for the market, for stocks in general in the near term. We're also seeing, along with that, the Russell, the small cap breakout. Another encouraging thing that we're looking at is the mid caps, which is the mid cap average now testing those highs from those all-time highs from last year, October, August, September, consolidating there, waiting for looks like it's building energy for another breakout higher. So we're still seeing a lot of constructive things as far as the internals and the breadth, and as long as those continue higher, we're going to be constructive on the market. Whether it's it was by and large the large caps for a long time now, we're seeing broader participation. We're also seeing broader participation in terms of international markets breaking out, various rotation among the sectors.
You have a view on the dollar, looking at emerging markets and so forth, that perhaps we have put in a significant dollar high, and does that go into your equation when you look at markets that suffered under a strong dollar?
It doesn't really. Our niche is the equity market, and this risk model that I was mentioning, a lot of it pertaining to internals and breadth. So that's really our core.
No divergences in any of the breadth numbers and internals that you look at? None?
No major divergences there.
Okay.
As far as we're concerned in terms of an intermediate term, which is that's basically the duration that we focus on. So that's anywhere from 2 to 6 months. As far as the dollar, I would say near term, I don't know that there's enough evidence to tell us that the intermediate term uptrend is over. Certainly in the near term, I think path of least resistance is certainly lower here. Broke this nice uptrend line from the 18, early 18 low, and path of least resistance.
I actually think that may be the catalyst for some of these overseas markets starting to do better, right?
It very well could be. I mean, that's that's the general thinking.
Trading 101.
Yeah, exactly. But I mean, if you look at some of these other, if you look at some of the emerging markets that we've been looking at, this is why we rely on prices and not necessarily this intermarket analysis where, okay, the number's heading up.
Correlations, they
Yeah,
break
because
down.
correlations change. So we've been looking at all year last year and even longer. We've been looking at Brazil and Russia. Here's the MySix composite in Russia. So the dollar was trending upward, right, all last year. Look at Russia has been moving to new all-time highs for the last couple of years since breaking out above these 07, 08 highs. Here's Russia continues to move to new highs. You look at Brazil, you know, that we've had the rising dollar for the last several years, or at least about the last
that
several
definitely
years. But
disproves
Brazil's been just cranking higher ever since the real breakout in 2017 above those 08, 09 highs, came back, tested in 2018, but it's been flying higher. So you've had, depends on what emerging markets you're looking at. You know, a lot of it is heavily weighted towards China, which has been terrible, and we're not fans of China.
So let me ask you this.
Concerned, and you look at the broad emerging markets index, which is heavily weighted to China, and it's been severely underperforming. So as far as that is concerned, that's been struggling. Maybe the dollar is aiding this one now, but you have various emerging markets around the country, around the world, that have been rallying already despite the rising dollar.
So what do you do with all the advances we have coming into a new year with fresh money?
You know, again, price is true. So we keep following whatever trends are working. It's as far as the broad stock market. Again, our risk model, our indicators are still constructive. So we're still in buy the dip mode. We are not in chase the market's higher mode. You know, we're not fans of chasing markets. So,
you would wait for a pause.
Yeah, I mean, we're patient in waiting for pullbacks, and we like relative strength. So whatever markets are working now, we like to focus on those. But you're seeing even among the equity markets, you're getting chances if you're patient at various entry points in longer term relative strength. For an example, you know, we bought. And we've been buying technology and healthcare and whatnot in the pullbacks. But even a couple weeks ago, you saw, you know, an acceleration of the upside in some of the large caps, some of the broad markets. But you had opportunities, for example, in real estate and the REITs, which had a great year. We've been on those all year. But you look back a couple weeks ago, you had here's the iShares real estate ETF IYR pulled back, and this was while we were breaking out in the broad markets, pulled back to support here on the IYR.
Kind of looks a lot like TLT.
Yeah, it looks a little bit like TLT, but we're accelerating now to the upside in again in
housing,
the REITs and real estate. Got a nice bounce here in RWR, the REIT index, and this is in the face of rising yields as well, which, you know, in this yields were kind of putting a headwind on this real estate here recently, but getting a nice bounce off of there. So again, the intermarket analysis stuff, sometimes it holds up, sometimes it doesn't. So we'll just we like to trade as far as, you know, we go along with our model. As long as it's bullish, then we're going to be buying stocks. As far as what we're buying, we like to rely on each individual chart on its own merits, not, you know, is the dollar moving up or down.
You have a view on yields?
Yields, sure. Depends on your depends on your time frame. Okay.
Yeah, so like we're starting to get a decent steepening, aren't we?
Yeah. So from a long, you know, 30,000 foot perspective, we think yields are long overdue for a long-term bottom. So we've been going down for, decades. I think
30 years.
we're in a bottoming process, where we're going to head up in yields for several decades to come. In the near term, if you zoom in, you skip the intermediate term, near term, I think we do have further upside to go on the 10-year. If we get above this 196 level, we're probably testing 212, maybe up into the 230s. But I think that's going to be a buying opportunity. I think we come down, maybe test these former lows again, or at least get a decent buying opportunity in bonds before that, before it's off to the races for the upside, to the upside. So
kind of meshes with what I've been thinking about in here. Okay. So how about, the miners have really had a nice run in the last few months or quarters. Anything in the miners, and the oils have been disappointing for a long time, and crude's trying. You see anything in the oil sector?
Oil sector, we're not that high on commodities in general, and crude oil in particular. Here's a look at the commodity index that we favor, the equal weight commodity index.
Okay.
Which, recently broke down below this multi-decade uptrend line. So on the plus side, it did break this downtrend line from 2011, which opens up in the near term further upside. So I think there's a little wind at the back of commodities right here. We would be sellers into any major resistance. So I think any rally here is probably a selling opportunity. Same thing.
And this is a commodity index.
This is a commodity. This is an equal weight commodity index. So you look at the CRB, it's really heavily weighted towards crude oil. This one spreads out the weighting among
ags and everything.
Yes, exactly. If you look at crude oil, this is a GSCI crude oil index that we look at. It's basically the same thing. I mean, we're seeing still way lower highs across the board. So nothing in our view to get excited about yet as far as crude. So we'd be sellers. But you mentioned precious metals. This goes to show you what a great year 2018 was for investors. I mean, it was we were basically in buy the dip mode in stocks, bonds, precious metals.
Everything.
Most of the year. Yeah. So
why do you think that is?
I mean, people are going to point to central
Fed?
bankers. Fed,
but you don't believe that.
I mean, I think that is certainly a component to it. When we're managing client money, we can't rely on that to make our investment decisions. We got to go based on the charts and what the market data is telling us. So I think there is definitely a component of that to it. But bottom line is, we don't care why it's happening. We're just going to go with the trend. So as far as gold miners and precious metals, we're in buy the dip mode still. So GDX, we trade the ETF. So GDX breaking above, it formed a nice little pullback here. We're in buy the dip mode, back above that 61 retracement now from that little dip here. So looking for higher prices there. One interesting thing, if you look at the skip the ETFs, you look at some of the broader indices among the precious metals. You look at the gold bugs index, which I don't think anyone looks at anymore except us. But I mean, you're seeing higher highs now. So above those August highs. Same thing with the XAU. A lot of people look at. So that's a great sign. Same thing with the metals themselves. We trade ETFs.
GLD.
We don't trade. GLD, SLV. GLD also testing that 61 retracement now, so could get some consolidation here, but no reason to think we don't continue higher from here. Same thing with SLV. Bought SLV on this pullback to around this good support around 1560 on this nice bounce. So we do have upside immediate term to that 61 retracement around 1720. Might get some consolidation, but we think this one goes higher as well. So we're still in buy the dip mode and precious metals
in everything.
Stocks. Pretty much in everything. So take it while you can get it, right?
You're right. Make hay while the sun shines. How about you have any view? I know it has nothing to do with trading. about all this, talk and all this, people trying to figure out what's happening in the repo overnight market. You're from Chicago. What are people saying about it?
Yeah, honestly, I don't have
You
an
don't know?
opinion on that because anything that doesn't really feed into our models, our
Boy,
quantitative
are you a
models, I don't,
disciplined guy.
well, I try to. I've learned,
get you to BS with me. You don't have to trade it, but
hey, I've learned through a lot of mistakes in,
yeah,
whether it was Y2K or,
yeah.
going way back or some of this,
Do you still
some
make mistakes?
Oh, sure. Obviously, make tons of mistakes all the time. Um,
Okay.
but the more and more mistakes we make, the more and more we learn. Okay, follow the rules, follow the quantitative models. They're a lot smarter than us. Follow the objective data. The charts are going to be a lot more truthful to you than certainly the news headlines. The great
That,
thing about
yeah,
news headlines,
yeah,
people get whiplash back and forth on them, and
yeah.
you have these Fed meetings periodically where you get
Or trade.
volatility.
Yeah,
Yeah, this a tweet comes out.
yeah,
These
yeah.
things are great. I mean, in the
You
near
like them.
term,
Yeah. All right.
they're opportunity makers. In the near term, it's going to bottom line is it's going to be noise. All this stuff is noise. Follow your process. If you have a quantitative and objective process, follow your process. If the market reacts contrary to your positioning, it's going to be noise. So fade it. If it presents if you're long, you're looking to buy it, and Trump comes out with a bearish tweet as far as the trade dealings and the market drops, I mean, that's a buying opportunity for you. Use it
Okay.
to your advantage. If it pops higher, there's no reason you have to chase it higher. So it's like either way you win. If it moves the needle in your direction, then take it. If it moves the needle the other way, use it as a
Add on.
buying opportunity. Yeah.
Add on.
So people tend to get emotional, which is what disciplined technicians are always gonna. It's always going to give them the edge because human nature is going to drive these markets. So use that human nature, the emotional reactions to your advantage. And
Worst drawdown in the last few years during the prolific bull market.
our worst drawdown has probably been during times where our risk model is rolled over into some indication of a higher risk market and a higher, elevated risk, and we've taken chips off the table where the market's just continued to head higher. So there'll
Okay,
be
so it was
times,
opportunity costs, not
opportunity
drawdown.
costs for sure. We've
Okay.
over the years, over the decades, we've kept
Yeah.
our actual drawdowns very low to a minimum, but opportunity costs for sure, especially over the last 10 years, where we have thought, okay, the secular bear market started in 2000. It's probably going to be drawn out for the better part of 2 decades. Whereas,
Yeah.
in reality, the last 10 years have been more or less not straight up. We've had decent intermediate term corrections in
Yeah.
11 and 2015 and 2018, which we
Okay.
avoided a lot of the pain.
Yeah.
But perhaps certainly at times we've not been aggressive enough in keeping.
Okay. That's interesting.
Yeah.
I know it's just an opinion, but it's a pretty long expansion, pretty long-term bull market, and I know you're just going to go with your stuff because it's smarter than us. But you've been around for a long time, and you're a veteran. And just gut, you think we have like another great year going into the election?
I don't know what the bulk of the year is going to do. I will tell you right now that our stuff again is still positively positioned. We're seeing a lot of breakouts, which have not always worked over the last decade or so. You get a lot of
false breakouts.
false
Yeah.
breakouts. You come down, correct, and then you move higher. But right now we're seeing a lot of positive factors out there that has us right now pretty long and looking to buy the dips further.
Okay.
So until that breaks down, we can't be that negative on the market. I will say, longer term, we're still of the mind that this. Here's a perhaps a contrary opinion for you. Long term, we think we still might be in a longer term secular bear market that started in 2000. This whole breakout, yeah, from 2013 when we broke the highs. We're still not sure that this is a sustainable bull market, a sustainable breakout. Would not be surprised to see once this whole song and dance ends that we go down and test at least those 2013 breakout, and perhaps even further. If you look at, here's the Dow. The interesting thing to us is that right now, even a retracement, 61 to the 61 percent retracement from the current highs. Look where it takes us on the Dow.
16,000.
Right down to this breakout point above those.
But how could you call it, after what it's done since 2000, still being a secular
That's why it's a contrarian. That's why it's a contrarian opinion. But if you take it back further, let me pull up a longer term chart. So the way that 2 points, this will feed into your whole the whole central bank Fed argument. Okay, in 2013, sure, we broke above those the former highs, 1500, and the S&P broke to new highs. Went to we have this breakout. Our feeling was that that the secular bear market did start. There's an email from you. Our secular bear market did start in 2000, and that a lot of the excesses, if you go back hundreds of years, you always have the secular bulls, secular bears. We have always gone to, once we go to an extreme to the upside, we've always gone to extreme to the downside, not just in prices, but in various metrics like valuation, in price versus
book value,
value, in the percentage of household assets and stocks. That never happened in 2009. Maybe we went back to about the mean. We've always gone to the other side of the mean before a secular bear market has bottomed, before a secular low has been put in place. So I think that's where the central bank and Fed intervention has prevented a lot of that correction from occurring naturally, which at this point, the problem is we never corrected those first excesses. Now we have additional excesses on the books that need to be corrected before a sustainable bottom is in place.
Because we would have well been coming out of it without the intervention.
I think we'd be now, right now, right? Yeah. So because we had a
so we have to pay the piper even more when the musical chairs game ends.
Exactly. We had this 18.
Will you call me the day? Buddy?
Sure. Well,
hit me up on
Twitter. They say bottoms are easier to point to than tops, so maybe the bells will be ringing.
Well, they say that markets top with violence and bottom in silence.
If you look at the volatility indices, you look at the VIX,
where you don't have violence yet.
I think it's the opposite. You have
with complacency.
You look at this top as kind of a process, whereas the bottom, you bottom like violently. The VIX spikes up to 1 million or.
I'm not using that saying anymore.
Yeah. Well,
thanks,
I don't know. You can use it. That's our. If you measure by volatility, I'm just saying it's kind of like my father always likened to like you throw a ball. You throw a ball in the air. Pace of acceleration slows to it almost stops in midair and then falls down. And when you drop it on the ground, it bounces up immediately, like quickly. So that's what I liken it to. Going back one more thing to our price, you said, how can we be in a secular bear market if we're moving to new highs? We always measure the secular bears from low to low. Okay, so you go back to this 1966 bear market. We bottomed in 1982, right? Everyone picked it off in 82. Well, we had already broken to new highs then, and we're certainly above those 1974 lows. But what we did was basically in 82 came back and tested a lot of the highs from the 66 to 82 bear market, came down, tested that, and then we kicked off the bull market. If the same thing holds now, then possibly we come down after this great bull market's over. Maybe we come down, at least test, which would be about a 38 retracement down to the 2015-16 highs.
Yeah.
Possibly down if it gets bad, which I wouldn't put it past the market.
Back to the breakout.
Back test those 2007 highs, which would be about a 61 retracement. So
what a great interview, man.
Yeah. Well,
what is a great way to kick off 2020. Why don't you show your website so people know how to find you?
Perfect.
And, your Twitter handle is JLionsManagement, @JLionsManagement.
Yep.
And our J-Lions Fund Management.
J-Lions Fund MGMT. Yep. Would be our Twitter handle. We do still have a Tumblr. You can search for jlfmi.tumblr.com for a free Tumblr. We also have, this is our new kind of our all access website is lionsharepro.com, where we'll give
you're not showing it, you're showing the chart. You have to probably have to stop the screen share and then show it again if it's on a different screen.
Okay, let me try to figure that out. Okay, stop share. How about now?
Share again.
Perfect.
Okay, there you go.
All right. Here's our new all access site. Again, we give every day before the pre-market, I'll give a outlook, short and long term, as well as we'll give a video, update all the charts that we're looking at, what we're looking to buy and sell, and also real time posts if we're on any sort of a major high conviction trade that we're looking at. So right now, again, that's mostly by the dips in stocks and precious metals and even bonds. So again, on Twitter, you can get a hold of us on Twitter. There's our Twitter handle. There's J-Lions Fund, MGMT, and
the skyline on Lake Michigan. I'll tell you what, Dana, it was great talking to you again. I wish you a lot of success in 2020, yourself, all your clients, money that you manage, that it multiplies for you. But my trading warrior brother.
I appreciate, Dale. It's been way too long. Let's not have it as long next time, right?
We won't. So,
Happy New Year, buddy.
Happy New Year, Dana. Everyone, that's Dana Lyons. Happy New Year, everyone. Let's kick some butt this year. Let's support each other. And most of all, don't just count your pips, count your blessings. And We'll see everyone to wrap up the week tomorrow. Adios, Dana.
All right. Take care, Dale. Thanks a lot.
All right. Thank you, bro.